Hello and welcome. In this lecture video, we'll be talking about disposal of plant assets. So we'll be talking about discarding plant assets and also selling plant assets, and then the associated journal entries with each of those situations. So as I say up here, why would a company want to get rid of a plant asset? So why would a company want to get rid of a truck? Well, maybe the truck's really old and it's obsolete. And it's worn out. It doesn't run very well anymore. Maybe they have changed their corporate strategy and they need to get rid of some plant assets to accommodate their new strategy. So there's various reasons why companies need to get rid of plant assets. They've changed their strategy. The assets no longer are able to do what they were intended to do. They're obsolete. So all those different reasons why a company may want to discard plant assets, okay? So when we talk about the journal entries associated with disposal of plant assets, the first thing that we have to do is we have to record depreciation up to the date of disposal and accumulated depreciation. So remember, the last time we could have recorded depreciation would have been the end of the prior year. So let's say we are going to dispose of an asset here in May of 2020, and then the last time we recorded depreciation was as an adjusting journal entry at the end of 2019. So when I sell the asset, I have to do a journal entry to record depreciation expense up through from January through May of 2020. So I have to debit my depreciation and credit my accumulated depreciation up to the date of the disposal. I also have to remove or zero out the balance of the asset in the journal ledger. Okay. And I also have to zero out the balance and accumulated depreciation. And I have to record any cash received or paid with the disposal, and then record any gain or loss. And what I would do to do this is I would compare what I sold it for, which would be the market value, against the asset's book value. Remember, the asset's book value is calculated by taking the asset cost minus accumulated depreciation. All right, so let's look at the situation. We are going to discard plant assets. Okay, so basically this means taking it to the trash heap, taking it to the dump, putting it out for trash. We're just not going to use it anymore. We're not going to sell it. We're just going to take it out to the trash heap. Okay, getting rid of the asset. So we have two different situations. We have a situation where the asset is fully depreciated. Okay. And then where we have the asset where we're going to discard that asset, but it's not fully depreciated. So let's look at the first situation where it's fully depreciated. So when it's fully depreciated, we have our asset cost of $9,000 and accumulated depreciation of $9,000. That means the book value is zero. So let's look at this in terms of T accounts. So remember, let's say this doesn't say what it is. Oh, it's a machine. Yeah. Machinery right there. And then we have accumulated depreciation. So we have our two T accounts. So this machinery, remember, has a debit balance of $9,000, and then accumulated depreciation has a credit balance of $9,000. So if I want to remove the disposed assets account balances, basically that's fancy talk for saying make the balance in machinery zero. Make the balance in accumulated depreciation account zero. How do I do that? Well, look at the T account. I've got a $9,000 debit balance. If I credit machinery, 9,000 minus 9,000 is out now zero. If I come over here with my accumulated depreciation, I've got this $9,000 credit balance. If I debit accumulated depreciation, zero balance. So my journal entry here is simply debit accumulated depreciation for $9,000, and then we will credit machinery for $9,000. Of course, this would be on June 5th, so on 6/5. That's our journal entry. Okay, and we don't need to do this first part, record depreciation up to date. Why? It's fully depreciated. It's no more depreciation. Okay, all right. So let's look at the situation though where we discard an asset that is not fully depreciated. Okay, so we have our equipment cost of $8,000, accumulated depreciation of $6,000, and then we're going to discard it on 7/1. So this is where we do have to bring that depreciation expense up to date. So that means we have to calculate depreciation expense. So it has 0 salvage value, straight line, and 8-year useful life. So I'm going to come over here. I'm going to take my 8,000, my asset cost, minus my salvage value of 0, divided by my 8-year useful life, gives me $1,000 a year. Okay, per year. So I'm discarding this on July 1st. So the last time I recorded depreciation, well, it's 12/31 of the previous year. So on 12/31 of the previous year, I debited depreciation expense and credited accumulated depreciation. So that means from January until July of this current year, I haven't recorded depreciation yet. So I have to now record depreciation from January through July 1st of the current year. That's 6 months. So basically I can take my yearly basis, multiply it times 0.5 because it's 6 months, half of the year, $500. So I will come over here and debit depreciation expense, $500, and then I will credit accumulated depreciation for $500. Okay, that's my journal entry. And so now what we can do is look at this in terms of T accounts. So remember we have our equipment right over here, and then we have our accumulated depreciation T account. Equipment, asset cost of $8,000. Now, what is accumulated depreciation after I do this journal entry? Well, you can see it's $6,000 as of December 31st, and I added another $500, $6,500. Okay, so my journal entry, we can see, is I'm going to be crediting equipment for $8,000, right? And then I will be debiting accumulated depreciation for $6,500. Okay, so I'll come over here and write that out. So I will debit accumulated, it's not accumulated, accumulated depreciation for $6,500. I will credit equipment for $8,000. Now you know that debits do not equal credits in this situation, and they need to for the accounting equation to stay in balance. So I'm missing a debit for $1,500. And so what I have to do, as you saw on that prior page, is I need to compare the market value. Well, in this case, I didn't sell it. So what I would do is compare the market value against the book value. So basically, I didn't sell it. So I have a loss of $1,500 because I didn't sell it. So 0 minus the $1,500 gives me $1,500. Okay, so this is my loss. So I'm going to debit a loss on disposal of equipment for $1,500. And this loss on the disposal of equipment is another expense on the income statement. Okay, so this will reduce our income. This is another expense on our income statement. All right. So now let's look at the next one, which is selling our plant assets. So we just did 2 examples with discarding plant assets, which is just taking them to the trash. Okay. One where it's fully depreciated, one where it's not fully depreciated. Now let's look at the situation where we can talk about selling our assets. Okay. So we have 3 situations. We can sell our assets at book value. We can sell our assets below book value, or we can sell our assets above book value. Okay. Remember, book value is equal to our asset cost minus our accumulated depreciation. So let's look at this first example. On March 31st, our company sells equipment that originally cost $16,000, has accumulated depreciation on December 31st of the prior year. Okay, annual depreciation is $4,000. The equipment is sold for $3,000 cash. Record the transaction. So we're given annual straight line depreciation. So the last time I recorded depreciation, last time I debited depreciation expense, credited accumulated depreciation was December 31st of the prior year. So that means I have to update depreciation for January, February, and March, 3 months. So I can come over here and multiply my annual times 3/12, which is going to give us our $1,000. So I will come over here and debit depreciation expense 1,000 and credit accumulated depreciation $1,000. Okay, that will be my journal entry. Now we can look at our T account over here for accumulated depreciation. So remember, I had this $12,000 and then I added another one, so I have $13,000 in accumulated depreciation. And then with my equipment, remember I have my initial asset cost of $16,000. So what I'm going to do is debit, right, my accumulated depreciation for $13,000. And then I'm going to credit my equipment for $16,000. Now let's look at here. It says I sold it for $3,000 cash. So I'm getting paid cash. So I'm also going to debit cash for $3,000. Okay. So now let's look at our journal entry to record the sale of the asset. So I'm selling it, which means I'm getting cash. So I debit cash for $3,000. Okay. And then I debit my accumulated depreciation for my $13,000, and then I credit my equipment for the original asset cost of $16,000. Okay, that's my journal entry to record the sale of my assets at book value. Now let's look at the next one. It's recording the sale of my assets above book value. Okay, same exact situation. Okay. So I have to update my depreciation. So it's debit depreciation expense. Just like we did before, because this is the exact same problem, except I'm not selling it for $3,000. I'm selling it for $4,000. So 1,000, credit accumulated depreciation 1,000. So our balance in accumulated depreciation, just like it was before, is our $13,000. And we're getting paid $4,000 cash. So I will debit cash for $4,000. I will debit accumulated depreciation for my $13,000. Remember, it's my $12,000 here plus my $1,000 right there. Okay. And then what I will do is I will credit my equipment for my $16,000. Now my debits don't equal my credits, right? So I'm missing a credit. And what am I missing? I'm missing gain. I'm missing my gain on sale of equipment. Okay? And this is an additional form of revenue, and it's equal to $1,000. So how did I get that $1,000? Well, it's a gain because it's $1,000 above book value. It's a gain of $1,000 because it's $1,000. I sold it for $1,000 above book value. How do I know that? Well, I sold it for $4,000. What's the book value at the time when I'm going to sell it? The $16,000 initial cost minus my $13,000 total accumulated depreciation, $3,000. Okay. All right. So what I want you to do is to pause the lecture video and try this one on your own, and then we'll check it. Okay. Okay, so let's see how you did. So we got paid $2,500 cash, debit cash $2,500, debit accumulated depreciation for $13,000, Credit the equipment. In this case, we have a loss of $500. Why? Remember, the book value is $3,000. We sold it for $2,500, $500 below book value. Okay. Thanks so much.